Most people spend their lives stuck in the 99%, working hard, saving a little, and struggling to get ahead. But what if I told you there are simple changes that you can make today that can allow you to grow your wealth virtually faster than everybody else around you? I'd say you're selling a scam. Well, I'm not talking about false promises or earning money without doing anything. I'm talking about putting your money in the right places to grow your wealth faster than most people. I'll just show you what I mean. There are three factors that will determine if you retire rich or retire broke. It's TRM. Time, which is how much time your money has to compound and grow. Return, which is how fast your money is doubling. And number three is money, which is how much money you're investing. The more money you invest, the wealthier you can become. The faster you can double your money, the wealthier you're going to become. And the more money your time has to compound and grow, the wealthier you're going to become. Now, none of us can go back in time 20 years and start investing when we were younger, so we're not going to talk about time. And I'm not going to talk about money because, well, I think we all understand you can either spend less or earn more to have more money to invest. But let's talk about how you can actually get better returns to grow your money faster. So I'll show you the power of this, and I'll show you how you can actually get better returns without taking on a whole lot of extra risk. If you invest $1,000 a month for the next 30 years and you just let that money sit in a savings account where you're earning 1% a year, that $1,000 a month is going to grow to $420,000. If you start investing that money but you're not the best investor, you let your emotions get the best of you and you get half the market average, which is 5% a year, but now your money is going to grow to $830,000. If you just put your money into the stock market, you don't try to find the right stock, you just own a piece of the stock market and you get the market average, which has averaged about 10% a year for the last 100 years, well, now your money is going to grow to about $2.1 million. And if you can do a little bit better than that, you can get slightly better returns than the market by being a little bit more involved, by investing in your research, by finding better opportunities, and you can average not 50% a year, not 200% a year, not even 15% a year. We're talking about just 13% a year. Well, now you're going to have $3.9 million. These returns are level one. They're non-existent because you're not investing your money. These returns are level two, where you're below market average because you're letting your emotions get the best of you. These returns are level three. You're just getting the market average. You're not really doing anything. You're just investing your money into the markets, getting the market returns. These returns are level four, more active investing, more risk for more potential return with the right work to help you get slightly better returns for more wealth. Now, I know what you're thinking. That's all great, Jaspreet, but everybody talks in theory like that. Nobody actually shows how to do it. Well, let me actually show you how to get these types of returns. If you don't like the idea of taking on more risk or researching stocks or putting in that work because it's just not interesting to you, great, no problem. Then what you should be focused on right here is how do you get the market returns? And the way that you get these market returns is just by investing your money in the market. Now, when I say that, I don't mean trying to find the next Tesla or Nvidia or Amazon. What I mean by that is you're just going to invest your money into the American economy because there are funds out there that allow you to own a piece of the United States economy. I'll show you what I mean. Now, full disclaimer, I'm not a financial advisor. I'm just a random guy on YouTube. I cannot tell you what to invest in. I'm just giving you examples for educational purposes only, and you got to make your own investing decisions because investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So when I say there are funds that give you exposure to the American economy, what I mean is that you have funds like ETFs, for example, VTI, SPY, and VOO. By the way, personally, I'm invested in VOO. These are funds that give you exposure to pieces of the American economy. VTI, if you buy one share of this fund on any brokerage, and pretty much every stock brokerage will allow you to invest in VTI, you will own a piece of the total stock market. So this gives you exposure to the 2,000 some stocks in the United States stock market. You don't have to go out and invest in all 2,000 of those companies. If you buy one share of this fund, you will own those 2,000 some stocks, and you don't have to do anything except buying one share of that fund, or as many shares as you want. But if you want to get a little bit more niche, you can also invest in the S&P 500. That's the group of the 500 largest companies in the stock market. So now we're not looking at all the thousands of companies, we're just looking at the 500 largest companies in the stock market, and you can invest in those 500 largest companies by investing in a fund like SPY or VOO. These are two different funds that give you exposure to the same 500 companies. And now as soon as you invest in one of these companies, well, you own those 500 stocks. And the nice thing about this is if one of those largest 500 companies starts to struggle, they will get kicked out of that fund and replaced by another stock, and you don't have to do anything. So hypothetically, McDonald's is a part of the S&P 500. If they start serving bad hamburgers and they start to struggle in the real estate business and they're on the verge of bankruptcy, well, McDonald's would be kicked out of the S&P 500 and replaced by another stock, and you don't have to do anything. That's the advantage of investing your money into these types of funds because, well, it's less work on your side. And the way that you win as a passive investor here is by following a strategy I call ABB. Always be buying. What that means is you need to create a system where every week, every 2 weeks, or every month, money is pulled out of your checking account and is automatically invested into your portfolio of funds. So if you were going to invest in the S&P 500, and let's just say that's the only thing that you do. The S&P 500 has averaged a little over 10% over the last 50 years and over the last 100 years. And so the way that you could do it is you just pick an S&P 500 fund. Again, I can't tell you what to invest in, but if you do that, now you set up a system where every week, every 2 weeks, every month, money is pulled out of your checking account and is automatically invested in your fund. And then you forget the password. You don't touch it. That's why I call it always be buying. That's the way that you win. So now when markets crash, you keep buying. Markets are booming, you keep buying. Markets are sideways, you keep buying. You have a Republican in the White House, you keep buying. You have a Democrat in the White House, you keep buying. It's raining, you buy. It's sunny, you buy. You get the idea. The mistake and the reason why so many people lose is because they forget this A. Always. They come up with whatever excuse that the economy is going to crash, that the dollar is going to collapse, that all these crazy things are going to happen, and so I'm going to stop buying. But if you stick with it, and you don't sell, and you hold on to it, it has been proven for decades to win. So if you want to get the market returns, the way that you do that is to always be buying and own some funds that give you broad exposure to the American economy. But what if you want to do slightly better? What if your goals are to get a little bit better returns, take on a little bit extra risk for more potential wealth? Because we can see that a little bit better gains can result in a lot more wealth over the course of your career because, well, the time and compounding of your money allows your wealth to grow even faster. Let's talk about how you can actually make it happen here. And I want to let you know that for those of you that are investors or want to become investors, I have a brand new investing masterclass that I put together where I walk you through how you can find investment opportunities before everybody else and how you can research those same investment opportunities. I'll show you the exact system that my firm and I use to find these investment opportunities before they hit the headlines. It's a ton of value in this masterclass. You can get it for free when you register, and we'll also give you access to Market Briefs, which is my newsletter for investors, complimentary, for free, at no cost. So if you want to get this investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to register. If your goal is to get better returns than the general S&P 500, it's going to take added risk, and many people will not do it, but you have more potential return. Now, when you understand it, you have to understand how you can actually make it happen. And this is where what I teach is you want to find the market shifts. That's where you want to understand where money is moving before everybody else hears about it. And this is where your research becomes very handy. So the best example that I can give, because everybody can relate to this, is in 2020, everybody started to buy cats and dogs, which meant more people started to invest money and spend money on pet care, pet food, pet services, which meant that created an investment opportunity for those industries for the people that understood that market shift. And that's where now you can find opportunities to grow your money faster than the markets if you're spending time on the research side of understanding where money is moving. And then you have to be able to analyze the stock to see which is the best stock out there, because just because you want to invest in pet food, well, there's a lot of companies, a lot of stocks that are servicing the pet food industry. So that's where you want to be able to do your research to be able to find those types of market shifts. This is the research that my firm does, is we are studying these market shifts. But then you can also take it a different direction, because there are funds out there that have seen these outsized returns that have beaten the markets, which come with added volatility. For example, the NASDAQ 100 is a group of 100 largest companies in the stock market that are not financial. So it's another index, kind of like these, that's giving exposure to the United States economy, but it's more specific on the largest 100 companies that are not financial, which essentially means the NASDAQ 100 focuses on tech stocks. We know that there's a lot of money flowing into technology. Why? 4 decades ago, a lot of money was flowing into the internet stocks. 3 decades ago, a lot of money was flowing into those same dot-com companies. 2 decades ago, money starts to flow into social media companies. 1 decade ago, money is flowing into social media companies, cryptocurrency companies, and a lot of different types of technologies. Today, money is flowing into AI companies. So there's a lot of money going into these types of tech companies, and there are funds that can give you exposure to that NASDAQ 100. For example, again, I cannot tell you what to invest in, but QQQ is an ETF that gives you exposure to the NASDAQ 100. And if we look at the history of QQQ, it has averaged 14% a year since it was created multiple decades ago. Now take a look at these numbers. The broad economy, those S&P 500, the stock market has grown by 10% a year. If you can get 13% a year, a slight edge, you can have a lot more wealth. We have seen the NASDAQ 100 grow by 14% a year, which is more than that. But what's the catch? Well, the catch with this is it's more volatile. What do I mean? Well, in 2000, when the dot-com bubble burst, the NASDAQ 100 fell by 78%, while the S&P 500 fell by around 50%. When the 2008 crash happened, the S&P 500 fell by 30-some%. The NASDAQ 100 fell by more than 40-some%. When the 2020 crash happened, the S&P 500 fell by around 30-some%. The NASDAQ fell by more than 40%. So the NASDAQ is more volatile. You see more upswings and more downswings, but over the last number of decades, we have seen the NASDAQ 100 outperform the general economy just because of the number of dollars flowing into the NASDAQ 100. But the reason why many people end up losing is because they can't handle that volatility. When markets go down, they panic. Well, they go down even further and even harder here. And that's what causes many people to lose. But for the patient, for the people that understand this, because next time we see a market crash, it could be because of AI, that the AI bubble imploded. Well, that doesn't mean that AI is going to go away, but it means that there's going to be a resetting of the AI companies out there. And that would obviously hurt those tech stocks. But for the financially savvy, again, that could create an investment opportunity, which is why when you understand this, yes, there are ways for you to get better returns. But you have to be financially savvy and understand the opportunity, because the problem and the mistake that so many people make is they end up getting these returns. Why? Because number one, they don't invest their money. Number two, when they invest their money, they get very emotional and they start trading their money and they don't even get the returns of the market. Well, when you understand this, well, now you can get the returns of the market. And for those of you that want to take it one step further and want to be more advanced, more risk or more potential return, well, there are ways to get slightly better returns by understanding market shifts, by understanding what types of funds that can give you those better returns with added volatility. I keep saying that because a lot of people are going to misconstrue what I'm saying, and then when the next crash happens, they're going to panic and freak out. It is going to crash harder than the S&P 500, most likely. How do I know? Well, that's what history has told us over the last number of decades. History doesn't exactly repeat itself, but it does rhyme. But when you understand this, you can start to find opportunities to get better returns than most people around you, because most people are just sitting up here, but if you can go down here, well, now you can amplify your wealth. Now the question that you understand this is, how do you actually make it happen? What do you do over the next 3 months to actually make this happen? So let me break this down in 5 steps. Step number 1 is lay your foundation. Step number 2 is systemize your money. Step number 3 is know what your financial goals are and work towards those. Step number 4 is to sacrifice and fuel the system that you've built. And step number 5 is to invest in yourself. When I talk about building your foundation, a lot of people get excited by the idea of investing, but they shouldn't be investing at that time. Now, I don't say this in a mean way, but the reality is you got to be smart with your money. If you don't have any savings or you have credit card debt, you shouldn't be worried about investing your money, because the reality is when something goes wrong, because things will go wrong, you got to have some money to protect yourself. So get at least $2,000 to protect you against an emergency. That's not the total amount of money you need to save, but to start, you got to have at least $2,000, and then pay off your credit card debts, your payday loans, and all those other high interest debts first, because the average market return is 10% a year. Your credit card is costing you 18, 20, 25% a year. So if you're paying 20% on your credit card, markets are giving you 10%, you would get a better return on your money if you paid off the credit card debt first. So lay your foundation, get out of credit card debt, and save a couple $1,000s before you even think about investing. Then once you have that base, now you want to systemize your money. What every wealthy person does is they have a plan. They know how much money they're going to save and invest and spend before they even earn that dollar. Everybody else earns money, they spend it all, and then they wonder if they have any money left over to invest and save. And this is where you got to have a system to save and invest your money first. And one of the simplest rules of thumbs that I teach is 75, 15, 10, which means for every dollar that you earn from here on out, it's going to follow this flow. And what this is saying is for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're going to invest. 10 cents is the minimum that you're going to save. Now you're going to open 3 bank accounts and you're going to automate this. And most banks are going to allow you to do this for free. If your bank is going to charge you money, get a new bank. The reason why you want to have different bank accounts is because you really want to have the protection to not accidentally spend your investment money, not accidentally spend your savings money. So go create 3 bank accounts and create a system where now you know every time you get paid, some amount of money is automatically going to go into your bank account that's holding your investment money. Some money is automatically going to this bank account, which is holding your savings money. And now you know how much money you got to save, how much money you got to invest, and it happens on autopilot. Once you know that, now you got to know your goals. Today we've been talking about investing your money to grow your wealth faster, which is great. But the alternative is you can also invest for cash flow, which means you're going to invest money and now you're going to get paid back some sort of payment. You get paid every month, every 3 months, every year for just owning the right investment. And now when you're investing for income, the goal is just to stack how much income you're getting. That way you can live off of that income. So you could either be investing for income or you can be investing for growth, or you can do a hybrid of the two. My personal favorite is income. I started investing for income, then I started layering on growth later on, but most of my investments are for income. That's why I invest my money in dividend-paying funds. I invest my money in real estate because my real estate pays me every single month. My dividend-paying funds are paying me every 3 months, every quarter. This is money deposited into my accounts where I don't really have to do anything except owning the right assets. Yes, it takes work to find those assets. Yes, it takes work to keep up with the assets. Yes, it takes work to research those investments. But once I own the assets, now they keep paying me. And then I can use this income to buy more assets to give me more income, or I can use this income to buy me a car, buy me a vacation, buy my house, whatever I want to do with it. But when you have enough income to pay for your expenses, now you are financially free. And you don't have to sell your assets because you have that income. So you got to know what your goals are. Some people love that type of income. Some people hate that income. Why do they hate that income? Because they say the value of your wealth is not going to grow as fast. Because if a company is making big profits, they can reinvest all that money to grow bigger and faster, or they can give this money away. And when they give that money away, well, that's money that they're not using to grow bigger and faster. Not to mention when they give this money away, you get your income. It's called a dividend in the stock market. You have to pay taxes on the income. And you have to pay taxes on the income even if you reinvest that income. So when you get that income, yeah, it's great, but you have to think about taxes and you have to think about growth. So you got to find what's right for you. Maybe you start with one, maybe you start with both, maybe you start with whatever you want, but understanding what your goals are, because then number 4, you want to sacrifice and fuel those goals. Once you start investing your money, you're going to see the power of it, and you're probably going to want to get to your financial goals faster. And the way that you can get there is by adding more fuel to the system. And either you can invest more aggressively, or you can invest more money, meaning you can earn more money. And this is where you can do both. You can work to earn more money, which is great. You can also work to live smaller so you have more money to invest, which is also great. The thing that I want to let you know is that there's a limit to how much you can cut back on your life. You can cut back the Starbucks, you can live in a smaller apartment, you can live in a smaller car, but there's a limit to how much you can cut back, but there's no limit to how much you can earn. Which is why there's a nice balance of the two, of working to earn more money while also making sure that you have a decent lifestyle for yourself. That way, now you have more money to invest. And now what you're doing is you're earning more money, not just to drive a faster car, but you're earning more money to have more investments which can buy you that faster car. See, everybody wants the nice car, but most people are not willing to wait to get that car. They just want to make the money and buy the car. And now you look like you're rich, but in reality, all you did was make BMW rich. But when you own the investments and those investments pay for the BMW, well, now you're actually free because you can stop working and your investments keep paying for the BMW. And now number 5 is invest in you. As you keep growing, keep investing in you, keep investing in your knowledge. This could be as simple as watching more YouTube videos, listening to podcasts. You can start reading more books on financial education, on building a business, on investing your money better. You can even start taking classes. You can invest in your own research. Whatever it is that you're doing, invest in how to make yourself better at that thing. So if you're investing in stocks, learn how to be a better stock market investor. See how you can get better research. See how you can get better data to find better investments. If you're investing in real estate, same thing. If you're building a business, same thing. The whole idea here is now you're going to be using your money smartly, that we have money to invest in now. After this video, you have the system, you have the strategy, that way you can invest better than 99% of people around you. I hope you got a lot of value from this video. Again, if you want to see how you can take your investing to the next level, I have a free investing masterclass that you can watch. I have that link for you down in the description. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.